Hello and welcome to this special macroeconomic show on the state of the economy, and the state of the economy is in wonderful shape. The second quarter GDP has come in at 7.6%. You know what the Reserve Bank's forecast was? 6.5%. To be fair, the governor said that there is an upside risk to this number about a month ago. But, our poll went up to 7. 7.6 is an absolutely blistering number. We will have to see a lot of upward revisions to the full year numbers as well, because we have a 7.8 for the first quarter, a 7.6 for the second quarter. So first half growing at 7.7. So the full year, currently the forecast standing at 6.5 is definitely going to be revised upwards. Well, let me have the pleasure of reading all the numbers. It's manufacturing that's just up and away. Taking it away at 13.9%, the second quarter manufacturing number. We did have an IIP average, industrial output average, coming in at 7.4. So people were prepared for perhaps an 8%, but nobody gave me a 13.9% number. Construction, likewise, blistering pace, 13.3% higher on construction. The nominal GDP growth is not very big. It's 9.1. That's because wholesale price index has been running negative. So while we have a real GDP growth of 7.6, you normally have a nominal GDP growth which is about 4-5 percentage points higher because of inflation. But at the moment it's only 9.1 because wholesale price index has been modest. Let me come to the other numbers. The GDP growth for April-September, the full half, is obviously 7.7. If you took the average, the GVA growth for the quarter under review, July-September quarter, has come in at 7.4%. So it's an extremely strong GDP number. Farm sector has not contributed. Our own poll had given a number of 2.7%, but it's nowhere near that. It's 1.2%. So clearly, the late rains perhaps affected the Rabi crop, and therefore the arrivals could be seen in the second quarter. We have to scout for the reasons, but that's the only one that's not performing. It was expected to always come weak at about 2.5%. It's done much worse at 1.2%. But making it up head over heels is the mining sector, up 10%. That was on expected lines. Our poll also threw up a number close to 10. Manufacturing 13.9 is a sure shot surprise. And construction sector at 13.3 is also a very significant surprise. So that's the GDP number for you. I will get you more details in just a bit because the numbers are just hitting the screen. We will have to do some calculations. But let me get some initial thoughts from our experts. Okay, let me just give the breakup for those of you who are listening. I've got Sakshi Gupta, the principal economist at HDFC Bank, Kaushik Das, the economist from Deutsche Bank, and Aditi Nayar, the chief economist from ICRA, joining us. Well, ladies and Kaushik, just listening to the numbers, I told you agriculture 1.2, mining 10%, manufacturing 13.9, electricity, gas, water, other utilities have grown at 10.1%. Construction is 13.3, as I told you. Trade hotels is a huge disappointment, 4.3%. I mean, I did get a middling number of 5 or 6%, but 4.3 for trade hotels, transport, communication, the biggest sector in terms of weightage. That's a bit of a disappointment. Financial sector, finance, real estate and professional services has done only 6%. And public administration, defense and other services is 7.6%. So I think we have an unusual time when services have not done as well as industry. The numbers will have to be calculated, but at the moment that is the big takeaway, that services have been a little under the weather, and manufacturing and industry are up and away. I'll give you the numbers from the demand side, from the consumption side in a bit, but let me get first thoughts from our experts. Kaushik, 7.6 first thoughts.
Yeah, Lata, this is really a good number, and we should feel good about India. India has been resilient throughout since COVID, and whatever we were expecting on growth in the last several quarters, it has always surprised to the upside mostly. And Governor Das had given an indication in one of the interviews earlier that growth could surprise to the upside. Now, all of us thought maybe it will be in the range of 6.8 to 7.1. But 7.6 is definitely a considerable upside surprise, and this will make people think about the forecast going forward, particularly the manufacturing. Nobody could have thought close to 14%. We never had that kind of forecast. So this is, first take is like, this is really good numbers, and we should feel good about the Indian economy.
Oh, absolutely. I mean, one would have thought that the GDP numbers were largely in the price, because I did get a poll number of 7%, already 5 percentage points, 50 basis points above what the Reserve Bank had forecast. I wasn't prepared for 7.6 at all. 7.1, yes. 7.6 is just superb. Sakshi, first thoughts.
Hi Lata. So yes, I think this number is, very big positive surprise. I think particularly as you highlighted the numbers on the industry side, from manufacturing to utilities, construction, all in double digits. Now we knew that there's a base effect, that will prop up the YOY numbers, but clearly these numbers suggest that there has also been a significant sequential increase, possibly being led by domestic demand holding up, and also lower input costs in that particular quarter. So I think this is a very encouraging sign, and I think this is perhaps the beginning of a theme that we are going to see going forward, where you start seeing this balancing, of economic activity from services to goods. Going forward, this is the trend that's going to play out even globally, and I think that we are beginning to see that sign in India as well.
Yeah, I heard some of our foreign experts tell us that earlier in the day, and I was a bit surprised, but this is absolutely exactly what they are predicting for the US economy as well. Huge growth in goods, not so much in services. I would have normally called services an okay number, but it just pales into insignificance when you look at this magnificent manufacturing and industry numbers. Aditi Nayar, to be sure, I want you to wax eloquent on the growth in manufacturing, but what explains this kind of tepid services performance?
Thanks, Lata. Well, we had penciled in 7% for today, so this is coming well above what we expected. In terms of the breakup, agriculture, mining and electricity are pretty much in line with what we thought. As you said, manufacturing and construction are higher. And the other services sectors have put, the growth estimated for them is lower than what we had forecast. So what I want to say is that manufacturing has shown the kind of number that I would have expected in Q1, when we had a much bigger tailwind coming in from commodity prices than we had in Q2.
Okay.
So in terms of the timing, I'm a little surprised. I was surprised last quarter when we didn't get a better number from manufacturing. And I'm surprised now that we've gotten such a high manufacturing DVA growth number in Q2.
Okay.
So I'm going to say I don't think it's going to sustain at these kind of levels going ahead. And perhaps when we end up getting revised data later on, there will be some rebalancing between these two quarters.
Well, I don't know. I'm not betting on that too much. Aditi, you would know better. But look at the October core sector number. 12.1%. And if you looked at the last 5 months, October definitely had a base effect. Last year, same time in October, there was huge rains, and therefore, obviously, cement and all didn't do very well. I think cement was 0.7 or something. Now it is like 17%. So clearly, there's a base effect. But even then, if you took the average from July to October, the average is running at 10% plus for core sector. Something is going so damn right that I don't know whether to bet that these will be smoothened as the time passes. Maybe a bit, but from 7.6, we are ready to give away 20 basis points. It would still be a grand number. By the way, in my poll, there was one person with 7.8, but just one person. Almost everyone was, around 7%, give or take 10 basis points up or down. So at least there's one person who perhaps is not going to be terribly surprised. I'll just read out the private final consumption number to you. Private final consumption at 8.2% higher is the underperformer. The better performer is government final consumption expenditure, 17.7% higher, and gross fixed capital formation up 12.4%. So personal final consumption, you would on a normal day not argue if a personal final consumption grew in real terms by 8.2%, but it actually pales when you look at the other sectors that have contributed in terms of demand. Clearly, a lot is being taken away by net exports because imports have grown very handsomely, and therefore that obviously has a negative impact on GDP from the demand side. But be that as it may, not too much by way of discrepancies as well. There was so much criticism about it. Well, not too much at this given quarter. Any thoughts, Kaushik, on this consumption and gross fixed capital formation numbers?
So, Lata, we had expected around 6.8 or something for private consumption. If it has come at 8.2, that's an upside surprise. And, private consumption is close to 56-57% of GDP. So, if you get a 8.2% number, I think very few people would have taken that kind of a number. And that's what the upside surprise is about from the GDP side. I guess, the thing is that in February, we'll get the numbers, the revised numbers for FY23, all the quarters. So we have to see whether that 7.2% growth that we got for FY23, is it revised, higher or lower? Depending on that, all these bases will change and we can talk about, different trends again. But as it stands, as of now, it looks like private consumption has been very strong and much stronger than what...
One minute. I read out the current prices. I'm sorry. I apologize for that. In real terms, private final consumption is actually looking a little under the weather. It's only 3.1%. My apologies. It was the current numbers. So private final consumption expenditure rises only by 3.1%. Any thoughts on that, Kaushik?
So Lata, I mean, I would have expected around 6.6, 6.7. If it has come at 3.1, then it's a downside surprise. But, you need to see all these numbers in totality. We have to, analyze these numbers and see there's a lot of base effect involved. And we have been getting a little lower private consumption numbers the last few quarters, probably because, the previous year's quarters need to be revised. And once those numbers come, you probably would see much higher growth for private consumption. And we know that private consumption has not slowed down to the extent that you would have, kind of worried about. And the urban sector is doing well. So these numbers should be taken with a little bit of caution because this could get revised higher. But definitely on both the fronts, GDP, GVA, if you're getting this 7.6, I think nobody expected that. If Governor Das did not give a signal, I think people would have, given even a lower forecast and would have got surprised even more.
Yeah.
So I think RBI has helped us to come towards 7% and still it has been an upside surprise.
Okay. Well, my apologies again for misleading you with the consumption number. I cannot still believe my eyes that it's not looking so good, especially when from the output side it is so good. Why would it be so poor from the consumption side? And income tax has been so good. It's been rising by 31% for practically any month you pick. The April, October, I just calculated because of the fiscal numbers, it's up 31%. So beats me why consumption should be so bad. But I'll give you all the other numbers now. In real terms, consumption is up 3.1%. Government final consumption expenditure is up 12.3%. And gross fixed capital formation up 11%. Sakshi, your thoughts?
So Lata, I think from the demand side, the private consumption number, and we also had a plus 6% growth, factored in for the second quarter, and this 3.1% growth is definitely a surprise, because a lot of the lead indicators that we are looking at on the demand side seem to be signaling that demand is holding up in the economy, both on the urban as well as the rural side. I think one possible reason, and I'm just trying to, match up supply and demand side numbers. You read out the number for trade, hotels and restaurants, your contact intensive services, and that is at 4.3%.
That's right.
I think even in the first quarter, the number was a bit of a disappointment, right? You have been seeing a lot of that pent-up demand effect kind of waning off. So, this is just conjecture, but that could be one of the reasons why on the consumption side, you are seeing, some amount of moderation. I think in terms of investment growth that, we are seeing, that was pretty much expected because we've seen very healthy traction in, capital expenditure both by the center and state in the first half of the year. So that's not such a big, surprise for me. I think on government consumption, there has been a lot of, spending on the revenue side as well.
Yeah.
We've seen front loading of Manrega, the LPG, tax cut subsidy, fertilizer subsidy, etc. So, again, that could be one of the reasons why you are seeing the government consumption expenditure being higher.
Okay. Well, it's time now to ask you all whether you all will be revising your numbers for the full year, and I'm sure it's going to be a yes. It's only the difference in degree. Aditi, your thoughts on the demand side numbers as well as will you be revising your numbers?
So Lata, typically the early estimates on the demand side numbers tends to undergo a huge amount of revision as more information comes in during the year. So I'm not going to be too upset about the PFCE number coming in sub 4%. Having said that, I do think that we need to be very cautious regarding the rural demand outlook given where we are with the agri sector indicators right now, with the rainfall and the reservoir situation and Rabi sowing lagging last year's levels. So I'm going to be a little cautious on the rural demand for the second half of the year. And I think overall there are a number of reasons that we do expect that optically growth rates are going to be lower in the second half of the year than in the first half of the year.
Yes.
So we have to keep that in mind. Having said that, today's number is 60 basis points higher than our estimate, which was already high at 7% for this quarter. So there is some upside to our full year growth forecast, keeping in mind the fact that we expect growth outcomes to optically look lower in the second half of the year than the first half of the year.
Okay. You'll have to do something like 5% in the second half for the RBI number of 6.5%, which looks a little unlikely at this point in time. I mean, the festival season appears to be anecdotally very good. We will get the auto sales number for November tomorrow, but October sales were very good. And October, a core sector which we have is a blistering number. So, I mean, it doesn't look like you can get 5 to 6% growth in the second half at all. So the number could be closer to 7. You think the full year, Aditi?
I don't think so, Lata. I think there are huge base effects which are pushing up the October numbers, and we must wait and see what the November numbers look like.
Okay.
Diwali was pushing up the October core sector number as well, not just the rain.
Fair point. There is the Diwali effect, but that would be more November. The October core sector still coming in good is perhaps also because there were late rains in the October last year. We will come with post-factor explanations, but the fact is that the number looks very good. Kaushik, what do you think? You think you will have to revise your full year number?
So Lata, mathematically, we have 6% forecast for October, December and 5.2 for January, March of 24. If I just keep that constant, mathematically the number comes up to 6.7 for the year as a whole. So if there are no revisions, I mean obviously there will be revisions to FY23, we don't know at this stage. So February will get those numbers. Okay. But as of now, the way it stands, I think there could be a 20 to 30 basis points upside to the 6.5 that RBI has given. So I've written about this that, when RBI comes into the next monetary policy, they probably would be revising up the growth forecast to 6.7, 6.8 for FY24. And then, in February, we'll see how the FY23 number looks like, the one that came at 7.2, whether it is revised higher or lower, depending on that, the basis will change. And we could talk about all that in details later. But as of now, I think there is a possibility of getting 6.7, 6.8 for this year, which will show that, compared to what we thought, the growth slowdown has not been that much. And probably FY25 is when all this rate hike and all this kicks in and people could revise it lower for FY25 because of the strong upside base of this year.
Absolutely. This will become the base next year. So, and of course, as you point out, you will start seeing them having an effect, the higher interest rates. Now, which brings me to how RBI will look at the whole thing. When you see an economy growing at this pace, you should be jamming the brakes somewhat. So, that question to you, Sakshi, do you think you will see the governor continuing to insist on removal of accommodation and continuing to pursue with some kind of financial tightness, maybe more macroprudential or microprudential rules like the risk weights? Do you think you will see a cautious RBI on December 8th?
Yeah, I I kind of agree with that, Lata. I think that, the RBI, I mean, given, the fact that on the inflation side as well, we are going to see inflation prints inching up now. Cereals, pulses, prices, etc., all, remain firm. And the economy seems to be doing much better than what we had expected. So there is room for the RBI to continue being watchful on inflation and take a rather hawkish stance and push back against, any sort of expectations that, they are looking at taking their eye off inflation and discussing any sort of rate cut. So I kind of agree with Kaushik on the fact that all the rate cut expectations that have been built into the market for next year are now will now start getting pushed forward towards perhaps the second half or towards the end of the year.
Okay. That's a fair assumption. There is no need for a rate cut. If anything, there is a need to let the economy grow at a steady pace, at a manageable pace. Aditi, any thoughts on interest rates, revisions?
So, Lata, I think we're in for a very hawkish commentary from the RBI, and especially if they're going to end up increasing their forecast for the full year, then I certainly think that that's going to come with a fairly hawkish commentary. Our view is that we don't expect any rate cuts before August of next year, and even when the rate cut cycle starts, we expect it to be fairly shallow at 50 to 75 basis points.
Okay, I just wanted to point out that this is the first time I'm seeing a 17.5% fall in government capex. Government capex for the month of October was 17% lower than the previous October. Of course, year to date is still handsomely higher. It's about, I'll calculate and let you know. It's a substantially higher number when it comes to April, October, but October itself has seen the capex numbers fall a bit. Kaushik, do you think even October merits revision? The GDP, I mean.
Yeah, Lata, I think October, November is a story about Diwali. So whichever month you have Diwali, there are lesser number of working days, and you get to see a high growth. So last year October was Diwali, and this year October we didn't have Diwali, so the number of working days were more. So probably that's why October number is coming higher. When you come to November, when we had Diwali this year, probably the numbers would kind of normalize. So you should take October, November average to get an idea about this Diwali effect. So I'll not jump into conclusion based on that. But the question on RBI, I think if I may take a little bit of time, I think RBI will sound hawkish. And now if you think what else they can do, they've already talked about tightening liquidity, maybe using OMO. I was just thinking through what RBI can do if they want to give a hawkish signal. Maybe one way to give a signal to the market is to raise the floor of the rate SDF that we have at 625 by 10-15 basis points, because today the effective market interest rates are close to 685-90. Repo rate at 650 doesn't make any sense. So in that case, if you want to sound hawkish, you probably could increase that floor rate of 625 closer to the 650 at least temporarily, and that could give a hawkish signal to the market.
Okay. I was thinking of a BAU kind of policy, business as usual policy, but with such an out of the box number coming in for GDP, it looks like once again the Reserve Bank's December 8th monetary policy becomes a little more interesting, a little more important to watch out, since they may want to lean on the other side. We have to wind up this discussion. I just wanted to add a little bit of caution on the third quarter. Our experts have already done that effectively, but I just want to add my calculations to it. I was looking at the fiscal numbers. The gross tax revenues April-September were up 16.3. April-October they are up 14%. So clearly October of this year has not been as good as October of last year. Likewise, corporate taxes were up 20% April-September. April-October they are up 17.3%. Good number, 17.3, but not as good as April-September. And likewise, I told you, capex, quite clearly, October capex is below the capex in October 22. So, there could be some things that are not going to work as well as they have done in the second quarter. But for the moment, it is a time for celebration. It's good to hear that the Indian economy is Yes, the fastest growing large economy, but it is faster than what the best estimates had estimated. It's growing at 7.6% for the second quarter, an excellent number, and it is going to lead to a significant revision in the full year GDP rates and perhaps global perception of India. We must watch out for how equity markets view this growth story and whether the flows therefore make it even more attractive in the second half. Lot of wealth over there. Thank you very much, Sakshi, Kaushik and Aditi, for reading the fine print on GDP. For us, it's a great fine print and it's a great overall number as well, 7.6%. We wind up on this special show. There's much more news and updates lined up for you. Exit polls time. So keep it with CNBC TV18. Lots of news lined up for you.